Hi Anna, welcome to Economics and Zoom Getting Coffee.
Hi, thank you so much for having me.
Of course, are you in Europe right now?
Yes, I'm in London right now,
Or what
enjoying
used
our
to be
lovely.
Europe? I don't know how to.
Oh, don't do that to me. We're still Europe in our hearts.
Okay, so maybe you're having tea instead of coffee.
I've got a oat milk latte.
Oh wow, okay.
Yeah.
I'm sorry if I made you drink coffee instead of tea.
No, I've been in America too long now, so I'm a coffee
Got
drinker.
it. Got it. Okay, well, cheers. So Anna,
Cheers.
I'm excited to have you, and it's been almost a full season of this show, and I'm excited to have you for many reasons. One of them is that you are just graduating. Congratulations from your PhD
Thank
at
you.
Harvard, and you're
Thank
going
you.
to MIT to be faculty at MIT.
Yes, I'm
Uh,
going to be an assistant professor at the Sloan School at the Institute for Work and Employment Research.
that's amazing. Congratulations. I guess that
Thank
you
you.
you did like the neighborhood, and you decided to stay around.
I guess so. I feel like I moved to Cambridge in 2013 thinking I would stay for 2 years, and it's now been eight plus.
Yeah,
So
don't we all? Yeah, that
I
happens.
think
I mean,
so.
not only in Cambridge, but everywhere in the world. That's
Yes.
that's the story of migration.
Yes, it
Um,
is.
So Anna, you're working on stuff that is really relevant, and I think that you are the scholar, what I think is the ideal scholar, who you are doing very rigorous research, very policy relevant and very timely, and contributing hugely to a very important discussion, and at the same time doing your efforts to put out your voice and your ideas out there to the policy world, which I think is a perfect mix of what an economist should be. But I'm biased. But
It's
but I
very
think
kind of
that
you.
it's great. And you've been working a lot on one of the big questions of our times, which is labor markets distortions or labor markets dynamics that are not, just to put it mildly, people are, the general public are not happy with it. I mean, we all know that there's a lot of distortions there. And I want to start by you explaining us the very basic aspects, right? So when we talk to economists, we always hear about the fact that wages and productivity should go kind of hand in hand together, but we have been seeing for the past decade or even more disparity between these two things, right? So productivity
Hmm.
continues to go up, wages don't catch up. So
Hmm.
that's a bad sign in terms of, or at least it's not what we expect as economists.
Hmm.
And at the same time, we always hear economists, including you, talking about the labor share is going down.
Hmm.
Can you explain us, like in words, what does that actually mean?
Yeah, absolutely. So these are all kind of parts of the same phenomenon of rising inequality in the labor market, and different aspects of rising inequality matter for different reasons. So one of the reasons that the idea of the productivity wage divergence has got a lot of attention is basically because what we've seen in the US for the last 50 years, really, um, less so in other countries, is that productivity has grown fast. That's the total output divided by the total number of hours people have worked. The value of what we're producing has grown fast, but
So, so,
wages
so
haven't
that's
kept
basically
up.
how much, it's how much a worker is able to produce in an hour of
Exactly.
work.
How much a
That's
worker
what we
is
call
able to,
productivity.
yeah, how much a worker is able to produce in an hour of work. And that's what we call productivity. And as we measure it, we see that it's risen at a couple of percentage points per year since, well, since a very long time, but the time I'm going to focus on since the early 1970s. But since the early 1970s in the US, you've seen the hourly wage of the typical worker, let's say the median worker, has only grown by much less. So this divergence has appeared where an ordinary worker, the pay that they're receiving per hour of work is growing much more slowly than the average value of an hour of work in the economy. And
So
so,
they're getting there for an hour of work. That's why the two numbers we expect them to go together, because for an hour of work, what I produce should be what I should be getting paid what I'm able to produce in an hour.
possibly. So that's an
Okay.
argument where we might expect them to go together. But the other important point is that productivity as measured by the amount that everyone produces divided by all the hours everyone works doesn't necessarily reflect the productivity of me, the worker sitting in the middle. So
Right.
you might see productivity rising fast and the wage of the worker at the middle, the median worker, rising slowly because that worker is not getting the benefits of what they're producing. Or you might see them diverging because the productivity of the people at the very top of the income distribution they're becoming much more productive and their pay is rising faster as well. But regardless of the cause of that, the reason why it's concerning is because the fruits of economic growth are not being distributed equally. And that's what that indicates, is the fruits of economic growth, the fruits of everything that our society does to make us more productive, which is partly public goods like education and healthcare and transport, and it's partly innovation, and it's partly individual people working hard. All of that combines to generate productivity growth. But the ordinary people in the middle of the income distribution are not seeing their wages grow in line with that. And so where are the gains going? Well, we know that from the story of rising income inequality, the rise in the incomes of the top 1% in particular, is that those gains of aggregate productivity growth are disproportionately going to the people who are at the top of the income distribution.
Right. So when we talk about how does that relate to this idea that we always hear that the labor share is dropping?
Yes, you did ask me that too. Sorry. So the labor share declining is basically taking the premise from a sort of class-based analysis, going back to someone like Marx and saying certain amount of the value of the income that we produce is earned by workers for work that they do, whether that's someone cleaning a room or whether that's someone processing a merger and acquisition deal. And then another portion of the income that people earn is earned by capital owners, interest on savings, returns on equity investments. And so the labor share is the share of total income that is earned through work, and the capital share is the rest, the share of income that's earned passively through investments. And so what we've seen in recent years in the US and somewhat less in other countries is a decline in the labor share of income. And the time at which this started is a bit debated. There's a lot of measurement issues that you can pick and choose which measure seems most relevant. But it started somewhere between the early 1980s and the early 2000s in the US. The share of income going to workers has been falling. The share of income going to capital owners has been rising. That relates to the productivity wage issue in the sense that part of that divergence of the wage of the typical worker and productivity is caused by divergence in the incomes of people who are earning labor income. That's like a middle income worker, their wages are growing more slowly than a high income worker who's in finance or consulting or something like that. And then the other part of that divergence is caused by this difference between the labor share and the capital share.
So you've been getting a little bit into the why, and I think the why is a very, very complicated question because I can imagine this has to do with a lot of the work that you're doing on the power of firms and the power of workers. I'm sure that you can add that in that mix like trade and globalization and a whole lot of things. But let's focus on what you've done. And I read some of your amazing work, but I'm gonna let you tell it instead of me because you're gonna be able to say it much better than me. But what are the typical explanations for this? And where do you come into the picture, like bringing a new vision about this?
Yeah, sure. So if we're thinking about the rise in income inequality broadly, I think you can categorize explanations into largely 4 buckets. One bucket is something to do with technology and skills. So in that set of arguments is that the rise in income inequality, and my work's particularly focused on the fall in the labor share piece of that, the rise in income inequality has been driven by technological progress continuing to reduce demand for workers with low educational levels and not enough workers sort of catching up to get more education. So one of the classic expositions of that argument is this idea of the race between education and technology that economists like Claudia Golden and Larry Katz have worked on a lot. And the idea there is that technological progress continue to automate workers. Think about automation of factories, think about now automation of checkout machines in grocery stores. And the workers that are displaced there isn't enough demand for the kinds of jobs that they can do, but there's growing demand for the kinds of jobs that workers with a college degree can do, like being a software engineer. And so because of the demand and supply patterns, that increases inequality between workers with more and less education. So that's one explanation. Another set of explanations focuses on globalization, as you mentioned, the idea there being that in rich countries, as globalization has increased, the competition from other countries with large pools of labor who will be able to or willing to work for lower wages has increased. And so particularly for workers in, say, manufacturing in America, which used to be a middle wage, middle class job with good benefits, that competition has eroded prospects for workers there, contributing again to the rise in inequality. And then the final two explanations focus less on what you might call competitive markets stories, technology and education or globalization, and more on imperfectly competitive markets. Right. And they're to do with monopoly power or worker power. So the monopoly power argument would be, broadly speaking, there's been this increase in concentration of big companies. Big companies are getting bigger, they're entering into more markets. As a result of being bigger, they have more monopoly power. More monopoly power enables them to make more profits. And that can explain why corporate profits are going up and income of capital owners is going up and income of workers is going down as a share of the total pie.
And these are the Walmarts of the world and the very big box companies.
You can think of these as Walmarts. You can think of these as the new tech companies more recently. In the past, you know, a lot of people who think about this argument compare it to the robber baron era of the early 1900s in the US. And then the last argument is about worker power, and that's where my work comes in. So in a recent paper that I wrote with Larry Summers, we were looking at basically explanations for the decline of the labor share of income in the US and other macroeconomic trends that we've seen. Like we've seen a big increase in stock market valuations that doesn't seem justified by economic fundamentals. We've seen increases in corporate profitability. We've seen rising what they call markups in companies, which is a measure of the difference between price and cost, which leads to the profit margin. And we argue that actually we think the most compelling explanation for the decline in the labor share is not any of those three that I already elucidated around technology, globalization, or monopoly power, but is a decline in worker power in the US. And that's the idea that a combined set of a mix of policy and institutional factors and economic factors has eroded workers' power to essentially share in the profits of the companies that they're working for. You can think of that most prominently as the decline in unionization, which has absolutely plummeted in the US from about 1 in 3 workers were unionized in the 1950s in the private sector, and it's now 6%. So basically zero. So this decline in worker power, we argue, is what has reduced the degree to which workers can share in the profits produced by their companies, and therefore redistributed income from workers to the owners of those companies, the shareholders, who are the capital owners. And that can explain that the labor share of income has declined and the capital share has risen.
So this monopsony power, or like let's just call it monopoly over the labor markets. Yeah. It's a good explanation, because then what you're saying, the firm can decide to pay a wage that doesn't necessarily reflect the productivity of the worker, and the worker doesn't really have any power to say, like as in the typical models that we learn in grad school, is that, well, if you're not paying me enough, I'll just move somewhere else and I'll get that pay, and that's how wages will be equivalent to your actual abilities or your actual productivity. But in those cases, that doesn't happen. And I know that you've been very involved in policy ideas because on this, right, in particular, because when we think about monopolies on the goods market, mm-hmm. There seems to be like a very decent understanding on that's not a good thing, and we have to have a bunch of regulations, antitrust regulations, to avoid that. Yeah. When it comes to monopsony or this monopoly on labor markets, there's really nothing much around it. And you looked into this, right?
Yeah, absolutely. So this is one of the really interesting things coming out of economics research in recent years. And I can't really take credit. It's other researchers, a few years before me, who've been reviving this idea of monopoly power in labor markets, and both in terms of the research, what causes it, how prevalent is it, and also the policy, what should we do? So one of the really interesting antitrust examples is, if you think about the idea of concentration, which we've talked about, which is the idea of there only being a few companies in a given market. So in a product market, if two firms are going to merge, and they're both selling the same product, then the antitrust authorities in whatever country you're in, but we can think about the US, the FTC, will evaluate the markets that the companies are competing in. And if they're going to make up too big a market share of the overall market when they merge, then they're going to trigger further scrutiny to try and understand if that's going to affect consumer prices, and they may actually block the merger or put conditions on the merger to make it not go ahead unless the firm, divests certain assets, sells certain branches, whatever it is, to ensure that markets stay sufficiently competitive. This has basically very rarely happened in labor markets. And I think it's partly because the dominant paradigm, for a while at least, was that workers have other options. You don't need to think of a labor market as something that a firm can really exert monopoly power over, because the worker can always get a job somewhere else. And what a lot of recent research has been demonstrating is actually, for a multitude of reasons, it's difficult to go and get a job somewhere else. You may have very specific skills or training. You may have a specific location radius around your house that you can work in. You may have specific scheduling needs, or you may just only have a few employers to choose from in your local labor market. And so some of what the policy options that I and others have been advocating for is for the FTC and other antitrust authorities to review labor markets like they review product markets. So if there's a merger application between, for example, two hospitals, and that's going to really consolidate the entire market for nurses in a particular area, then they have to actually review the anti-competitive impact of that on nurses' wages and consider that before they allow the merger to go ahead. And increasingly, antitrust authorities are planning to start doing this, which is very reassuring.
So Anna, explain to us, how do we get there? What were the dynamics, or what do you see in the data that explains how did we get to that point where unions were very prevalent, to this point where they're basically non-existent, and therefore the worker power is very, very low?
I think to answer the question about how we got here in terms of the labor market, you almost want to start even earlier and look back to the early part of the 20th century, which is when we saw a big increase in worker power, from which we then saw a decrease in the latter part of the 20th century. So what do I even mean by worker power? Well, we've talked a little bit about unions. And again, this is one of the biggest manifestations of it. You see unionization rates massively increasing in the US in the early 20th century. And then you see in the 1930s, unionization being explicitly becoming a protected activity. It becomes, there is legislated a right to strike, a right to not be dismissed for union activities, and various protections. And this, plus public support and often a lack of management resistance, leads to a big increase in unionization up to about the 1950s. Then you see unionization start to slowly trickle down from the 1950s to the 70s, and then it starts to decrease very rapidly from the 1970s onwards. And unionization I'm focusing on a lot, partly because it was just very big. As I said, a third of private sector workers were unionized at the peak, but also partly because unionization, increasing body of evidence suggests it had spillover effects on workers that are not unionized. So if I am a worker at a plant that is not unionized, but my manager knows that me and my colleagues could unionize, and the manager wants to avoid that, they may also pay me higher wages, give me better benefits, give me better working conditions to avoid that. And so there's this spillover effect of unions that goes beyond just the workers that are unionized themselves. So the decline of unionization since the 70s, really in particular, has been a big factor in how we got here. And that was triggered partly by increasing hostility from policy and from firms to unions, and partly by an economic environment that eroded the industrial sectors where unionization was most prominent, if we think about manufacturing, and the decline of employment in manufacturing as a result of automation and globalization, and a failure of unionization to newly unionize the sectors that are growing in as much quantities.
So the
like
structural
retail.
transformation process of the country, you move towards sectors that, for some reasons, unions were less common or didn't grow there.
Yeah, were less common and then didn't grow. And then the question of why they didn't grow, I think, is quite debated, but is in my view a lot to do with the fact that it's very difficult for unions to grow now because there's quite a hostile policy and institutional environment towards them. But that's sort of mechanically is partly a result of the decline of manufacturing and the rise of retail.
And there's some, this is completely anecdotal, but in a previous life, I worked in the private sector, and not in the US, in another country. And I kind of, in my first year at the job, they told me no unions. You can't organize. So that's one of the rules. If you want to stay here, you can't organize. It was a high-tech company in Israel. So yeah, I've been on that side when it was a very clear part of their instructions.
And that's really interesting because I don't know the legal environment in Israel, but in the US, you hear that story all the time. It's of course, it's illegal for a company to threaten or fire you for unionizing, but most workers don't want to take that chance or don't know that. And even if it is illegal, I've actually just got a paper out this week showing that there's basically no penalty for it. So a lot of companies will do it anyway, even if it's illegal.
So okay, Anna. So that's super clear, and I'm wondering a little bit about the future.
Mm-hmm.
I know we're both economists, and we're terrible at predicting, especially when it comes about the future. But we're seeing kind of starting to see what looks like a trend in which a lot of occupations in a lot of industries might work more from home. I probably not very much among the people that are suffering most from this dynamic. But I mean, at the same time, if this actually happens, this means that this person in the factory town that you mentioned before could have other options without really needing to move to another place physically. So that will actually, I mean, do you see this as a potential way of increasing this power, this worker power that has, you know, that it's orthogonal to the regulation area?
Yeah, so I think this is a really interesting and important trend, and one of the only possibly good things to come out of this entire tragedy that the world has lived through the last year and a half. There are two angles on the remote work thing that I think can push in different directions, and so let's explore both of them. The first angle is the one you mentioned, which is as more and more jobs can be done full time remotely, that reduces the need for companies to have people in specific cities like in the US, San Francisco, or New York, or Boston, and therefore opens up the pool of possible people who could work from elsewhere. And this does mean that if you have someone who is qualified to work for a tech company in a declining factory town in the Rust Belt, they can now do that from there. And I think I agree with you that that is possibly hugely beneficial as a way to create clusters of innovation, of high wage, good quality jobs in places that have been declining. And actually, I'm working on a project right now in the UK thinking about regional inequality here. We have a very similar issue with large swathes of the country that struggled after deindustrialization and have failed to catch back up to the UK since then. And that's one of the options that we're thinking about is how can the government encourage remote work, high skill, high tech clusters to build in these places? But the other side of that coin, and I think this is great for the world, but not good for the towns that we're talking about, is that why would you hire someone in um, the Midwest when you could hire someone in Ukraine or India or any other part of the world who is very well qualified and who
Right.
at prevailing wage rates in those countries would charge a lot less for the same work? And so I think once remote work becomes a full-time possibility, we're going to see a massive offshoring of service jobs from um, industrialized economies to developing economies. And this is an idea that Richard Baldwin in his book Globotics has actually
Right.
talked a lot about even pre-pandemic. And this is fantastic news for the many, many, many workers who are sufficiently qualified in developing countries to be able to get better paid jobs and have better lives and have more interesting work lives potentially as well and have better career potential and also to feed that through into their communities. So I think it's a great thing for the world, but it does mean that that benefit of remote work spreading within industrialized economies, I think, is more likely to be limited.
One more question on this issue that you are describing, which it's very sound and I think makes a lot of sense. But I'm sure that you get a lot of pushback, or you will get a lot of pushback, because there's also this argument of like, I mean, I don't know how much based on evidence it is, but when workers unionize and then they are, you, this will have, I don't know how to put it in words, but this will have costs for the economy too, right? It could be
Yeah,
unemployment.
yeah.
It could be also like, inflation to some. I
Mm-hmm.
mean, just in the fact that the prices of goods are going to be higher because the cost of goods are higher,
Right.
unless there's a lot of monopolies. It's a complicated question, I know, but what is your answer to that crowd that tells you like, no, unionization is a terrible idea because, then we don't have any, we lose the competitive edge that a firm or a country could have.
Yeah, so I mean, I think these are important questions to raise, and I don't at all think that they should be, dismissed. And they're things that I think about a lot. I want to separate my answer into kind of descriptive, what does the evidence tell us, and then normative, what should we do about it? Because I think they're actually quite different and often are conflated. So, in the descriptive sense, the two big costs, as you've mentioned, of unionization and worker power people often bring up are higher unemployment. The reason for that would be if workers are paid more, it's more expensive to create jobs, and so firms create fewer jobs. It's very intuitive. Higher inflation, as you said, higher price level if the cost of goods rises as wages rise, but also potentially higher inflation if you get into a kind of wage price bargaining spiral, which is what some people argue is how we got into the high inflation period of the late 60s to 70s. And you've got a third potential cost, which is effects of unions on innovation. And is it possible that sort of worker power stultifies an economy and it reduces innovation and creative destruction and investment and all of the things that help us grow over the long term? And there are good theoretical reasons for you to believe all three of those or for you to not believe all three of those. So the answer really comes down to, what does the data tell us? I think it's quite possible that unionization somewhat increases unemployment on average, although I don't think the data is conclusive on that. In my paper with Larry Summers, we did see that states with bigger declines in unionization saw bigger declines in their unemployment rates over the last 40 years. However, we don't yet know what type of unemployment that is, that unionization necessarily creates. So you're probably likely to be much more worried about a big increase in long-term unemployment with certain segments of the labor market just permanently excluded than you are from an increase in what we might call wait unemployment. If everyone waits a month longer between finding jobs and we have generous unemployment benefits, maybe that's fine. Everyone's waiting to get a slightly higher paid job at a good unionized firm rather than taking any job that they can get at the bottom of the labor market. That might be a recipe for a healthier economy and labor market, even if the number is slightly higher. The other point is, if we look at the cross-country evidence, if we looked at this in the 80s, we would have said, oh my goodness, all the heavily unionized economies in Europe have incredibly high unemployment. The US has incredibly low unemployment and doesn't have as strong of a union environment. Maybe this is telling us that this theory that unemployment is massively caused by unions is true. But if you look at more recent evidence, it's a bit more mixed. Somewhere like Germany, that has strong unions, has had very low unemployment in periods outside of crisis. And so the evidence is no longer dispositive in the cross-country sense that unions cause unemployment. Inflation, we haven't had any meaningful inflation for the last 30 years, so I'm not worried about it. I'm of the school of thought that we can tackle it when we come to it. And there's a lot one can say about that, and I'm happy to. And innovation, I think the evidence is becoming very clear that unionization doesn't seem to have any negative detectable effects on innovation or investment. So the one I would be concerned about is unemployment. That's where the normative part comes in. The descriptive part is the one thing we might be concerned about is unemployment. I don't know how much we should be concerned about it. But if we are concerned about it, what do we do? One school of thought is, okay, unions create unemployment, therefore we just have to accept a labor market with low worker power, low wages, and low unemployment, rather than one with more worker power but more unemployment. Or you could say, maybe, and this is where my normative views come in on what a good society looks like. I think a radically more equal society is a good society and one we should be aiming for. And so I would say, well, if unions do cause unemployment, we should be aiming for a society with worker power, plus lots of other support, perhaps a job guarantee, perhaps some kind of a universal basic income or generous unemployment benefits, such that unemployment isn't a sentence to poverty and misery and lack of healthcare and eviction for an individual and their family. And that would make unemployment much less problematic. And so those are the two pieces of that argument,
right.
I think.
Look, that's fascinating, and it looks like you're going to have a lot of work and demand with your research for the next few years. We ran out of time, unfortunately. I have like 100 hours more of questions that I hope I can ask offline. But it's so great, really, to listen to your research and your ideas, and I think they are making a big change, and they will continue to be. So we're going to be looking after what you're going to achieve in the next few years.
Thank you. This has been really fun, and I hope my answers weren't too long. When I get going, I don't stop.
It's good. Thank you, Anna.
Thank you.